Look, I need you to understand something that is happening right now, this exact weekend, while you are sitting at home watching the news cycle scream about military buildups and geopolitical tension in the Middle East. While Bloomberg is running their panic porn about the $80 silver breakout and CNBC is interviewing some clown in a tie telling you to buy the dip in tech stocks, there is a massive financial crime being executed in real time behind the boardroom doors of America's regional banking system. I am talking about a coordinated institutional cover-up that is so brazen, so desperate, that if you actually understood what these people were doing with your money this weekend, you would be pulling every single dollar out of your checking account on Monday morning. The FDIC just seized Metropolitan Capital Bank. They shut the doors. They walked in on a Friday afternoon, took the keys, and told the depositors that their accounts were being transferred to a larger institution. The official story? Unrealized losses on commercial real estate debt, toxic bonds. The same excuse they used in 2023 when Silicon Valley Bank collapsed. The same script. But here is what they are not telling you. Metropolitan Capital was not an isolated failure. It was a symptom of a systemic insolvency crisis that is ripping through the entire regional banking sector right now in 2026. And the smart money inside these institutions is not sitting around waiting for the regulators to show up with the seizure notice. They are executing a wealth transfer protocol that has been written into the global banking rulebook for years, and almost nobody in the retail investing public has any idea it exists. I am talking about Basel III. I am talking about Tier 1 asset reclassification. I am talking about the fact that while your bank is telling you that your digital deposits are safe and insured, the people running that bank are quietly draining the vaults of physical precious metals to save their own balance sheets before the entire system implodes. This is not speculation. This is regulatory arbitrage. This is survival. And if you do not understand the mechanics of what is happening right now, you are going to be the one holding the bag when the currency resets and your purchasing power evaporates overnight. The suits at YouTube want me to tell you, this is not financial advice. Of course it is not financial advice. It is a field report from the front lines of a financial war zone. It is a survival manual for people who are smart enough to realize that the institutions you trust with your life savings are run by people who will throw you under the bus the second their quarterly bonus is at risk. Do your own research. Talk to your own advisors. But understand that the advisors working for the big banks are reading from the same script that told people everything was fine in 2008, everything was fine in 2020, and everything was fine in 2023 before the regional bank crisis. They are paid to keep you calm while the people at the top of the pyramid are moving their wealth into hard assets. So yes, do your own research. Just make sure you are researching what the central bankers are actually doing, not what they are saying on CNBC. Let me know in the comments below, and I want you to be brutally honest with yourself on this one. Do you actually believe your bank holds enough reserves to cover your digital deposits? Do you trust that when you log into that banking app and see the numbers on the screen, that money is actually sitting in a vault somewhere with your name on it? Or are you starting to realize that the fractional reserve banking system is a confidence game, and the second that confidence breaks, your deposits are nothing more than a liability on a balance sheet that is drowning in unrealized losses? Let me know in the comments. Are you pulling your wealth out of the system? Or are you still trusting the FDIC insurance fairy tale? Because I need to know if this audience understands what is at stake here, or if I am screaming into the void while the financial establishment loots the middle class in broad daylight. Now, let me walk you through the actual mechanics of what is happening, because this is where it gets technical, and this is where the mainstream financial media completely fails you. They will not explain this because if they explained this, you would understand that the entire global banking system is designed to protect the institutions, not the depositors. We are talking about the Bank for International Settlements, the BIS, the Central Bank of Central Banks, the people who write the rule book that every major financial institution on the planet has to follow. Back in 2019, the BIS finalized a set of regulations called Basel III. You heard about this in the headlines. The media told you it was about making banks safer after the 2008 crisis. More capital requirements, more transparency, all the buzzwords. But what they did not tell you is that buried inside Basel III is a reclassification of assets that fundamentally changes the way banks measure risk, and it creates a massive incentive for failing institutions to hoard physical precious metals. Here is how it works. Under the old Basel II framework, unallocated paper, silver, gold futures contracts, and other derivative exposure to precious metals were treated as relatively low-risk assets. Banks could hold paper claims to gold and silver on their balance sheets and count that as part of their capital reserves. But Basel III changed the game. Under the new rules, unallocated paper metal is now classified as a high-risk liability. It is treated the same way as a speculative equity position or a junk bond. The regulators looked at the 2008 collapse, they looked at the rehypothecation scandals where the same ounce of gold was claimed by 15 different counterparties, and they said, "We are not going to let banks pretend that paper promises are the same as physical reserves." So they reclassified it. Paper metal is now risk on, but here's the kicker. Physical allocated precious metals, gold and silver that is sitting in a vault with a serial number and a chain of custody, is now classified as a Tier 1 risk-free asset, the same classification as cash. The same classification as sovereign bonds. If you are a bank and you hold physical gold or physical silver in allocated form, the regulators treat that as the safest possible reserve asset you can have. It is a zero-risk weighting. And if you are a regional bank, sitting on hundreds of billions of dollars in unrealized losses from commercial real estate loans and long-dated treasury bonds that you bought at 0% interest rates before the Fed jacked rates, up to 5%, you are looking at your balance sheet right now, and you are realizing that you are insolvent. You are technically bankrupt. The only reason the FDIC has not shut you down yet is because they are letting you pretend that those bonds are worth par value as long as you do not sell them. It is called mark-to-maturity accounting. It is a regulatory fiction. But the second depositors start pulling their money out, you have to sell those bonds at a loss to cover the withdrawals, and boom, you are Metropolitan Capital Bank. You are done. So what is a failing bank supposed to do? They cannot raise capital by issuing new stock because nobody wants to invest in a zombie institution. They cannot sell their toxic assets because that would force them to realize the losses and trigger a regulatory seizure, but they can do one thing. They can buy physical precious metals. Because under Basel III, the second that metal hits their vault and gets allocated to their balance sheet, it is a Tier 1 asset. It is treated as zero-risk capital. It instantly improves their capital adequacy ratio. It makes them look safer on paper. It buys them time. And if the currency system collapses and we go into a global sovereign debt crisis, which is exactly where we are headed in 2026, that physical metal is the only asset on their balance sheet that is actually going to hold value. Everything else, the bonds, the real estate loans, the mortgage-backed securities, all of it is denominated in a fiat currency that is being debased at an accelerating rate. But gold is gold. Silver is silver. It is elemental. It is finite. It is the only asset that does not have counterparty risk. So the banks are not idiots. They know the game is over. They know the fiat experiment is ending. And they are using the Basel III regulatory framework to quietly drain the global physical metal supply before the public figures out what is happening. I spend hours every single week reading through these massive Bank for International Settlements regulatory documents, the Basel Committee on Banking Supervision reports, the Financial Stability Board white papers, all of this central banking bureaucracy that is written in the most boring technical language imaginable, specifically so that normal people will not read it. I translate this stuff into plain English so you can see exactly what the global financial elites are planning and how they are positioning themselves to survive the collapse that they know is coming. If this kind of insider macroeconomic intelligence helps you protect your family's wealth, if it gives you the information you need to make decisions that your financial advisor is never going to tell you about, then consider hitting that super thanks button below this video. It directly supports the channel. It tells YouTube that this content is valuable and that the algorithm should stop suppressing it. And it allows me to keep doing this research without having to sell out to some corporate sponsor who is going to tell me what I can and cannot say about the banking system. Now, let me show you the hypocrisy that is at the core of this entire operation, because this is where it gets absolutely infuriating. The same banks that are hoarding physical silver and gold under the Basel III loophole are the same banks that are suppressing the paper price of those metals on the COMEX futures market. You are watching silver break out to $80 an ounce this week. The headlines are everywhere. But if you actually look at the mechanics of how that price is being set, it is not being driven by physical demand. It is being driven by speculative futures contracts and algorithmic trading on the paper market. The big bullion banks, JP Morgan, HSBC, the London Bullion Market Association clearing members, they are the ones who are authorized participants in the COMEX silver market. They can short unlimited paper contracts into the market to cap the price whenever it starts to run, and they have been doing this for years. We saw it in 2011 when silver hit $49 and then got smashed back down to $26 in a single week. We saw it in 2020 when the Reddit crowd tried to squeeze silver and the price got capped at $30. Every single time retail investors start piling into silver, the paper market gets flooded with short contracts and the rally gets killed. But here is what is different in 2026. The banks are not shorting silver to defend the dollar anymore. They are shorting silver to buy time to accumulate the physical metal at suppressed prices before the system breaks. Think about the game theory here. If you are a major bank and you know that Basel III is forcing you to hold physical metal to survive the next crisis, but you also know that the public is waking up to the metal trade, you have a problem. If the price of silver runs to $133 an ounce, which is the technical target that every chartist on the planet is watching right now, then the cost of accumulating physical inventory becomes prohibitive. You cannot afford to buy enough metal to repair your balance sheet. But if you can use your position as an authorized participant in the COMEX futures market to short the paper price and keep it suppressed at $80 or $85, then you can quietly buy physical metal from the refineries, from the mints, from the sovereign sellers, at a discount to where the price is eventually going to go. You are front-running the collapse. You are using your market-making privileges to rig the price in your favor, while you accumulate the hard asset. And then once you have your vaults full, once your balance sheet is safe, you let the paper market break. You let the price run to $133, to $200, to whatever level the physical shortage takes it to, and at that point you are holding the asset that everybody else is desperately trying to buy, and you sell it back to them at the top. It is the ultimate insider trade. It is legal robbery. And while this is happening, what is the mainstream financial media telling retail investors to do? They are telling you to buy tech stocks. They are telling you to trust your bank. They are telling you that inflation is under control and the Fed has everything figured out. They are running segments about how gold and silver are barbarous relics, how crypto is the future, how you should keep your money in a diversified portfolio of equities and bonds. Meanwhile, the people running those banks, the people who own those media companies, are draining the COMEX registered vaults of physical silver. I am talking about the eligible to registered reclassification scam that has been going on for months. Eligible silver is metal that is sitting in a COMEX warehouse but is not available for delivery. It is owned by someone else. It is just being stored there. Registered silver is metal that is available to be delivered against a futures contract. Over the last 6 months, we have seen millions of ounces of silver move from registered to eligible, which means it is being pulled out of the deliverable supply and allocated to a private owner. And who do you think is doing that? It is not retail investors. Retail investors do not have access to the COMEX warehouse system. It is institutions, it is banks, it is sovereign wealth funds. It is the same people who are telling you on television that silver is a dying market. I am tracking the COMEX vault inventories every single week. I am watching the drawdowns in registered silver. I am watching the delivery demands in the futures market. I am watching the spreads between the paper price and the physical premium at retail dealers. And what I am seeing is a system that is on the edge of a force majeure event, where the exchange is going to have to admit that they cannot deliver the metal that they sold. When that happens, the paper price becomes irrelevant. The only price that matters is the physical premium, and that premium is going to explode. We saw a preview of this in 2020 when the pandemic shut down the mints and you could not buy a silver eagle for less than $35 an ounce, even though the spot price was $18. That was a 2-month supply shock. What we are heading into in 2026 is a structural supply deficit that is being driven by industrial demand, by monetary demand, and by institutional accumulation under Basel III. The banks are buying the dip. They are buying the physical metal while they short the paper market. And when the paper market breaks, they are going to be the only ones holding real wealth. Make sure you are subscribed to this channel with the bell notification turned on, because when the COMEX registered silver inventory drops below 30 million ounces, I am going to release an emergency update video breaking down exactly what that means for the paper market and how fast the premium is going to spike. You do not want to miss that analysis. Now, let me tie this back to the geopolitical dimension, because this is not just a domestic banking crisis. This is a global monetary reset, and the Basel III regulations are part of a coordinated strategy by the central banks to prepare for the end of the dollar reserve system. You have to understand that the BIS is not a US institution. It is based in Switzerland. It represents the interests of central banks all over the world, including the People's Bank of China, the European Central Bank, the Bank of Japan, the Bank of England. These are the people who are writing the rules. And when they reclassified physical gold and silver as Tier 1 assets in 2019, they were sending a signal to the global banking system. They were saying, the fiat system is ending, and you need to have hard assets on your balance sheet when it does. The Chinese government understood this immediately. That is why China has been accumulating gold at a record pace for the last 3 years. The official reserves reported by the People's Bank of China have gone up every single month. But the real number is much higher, because the Chinese are also buying gold through state-owned enterprises, through sovereign wealth funds, through private accumulation channels that do not show up in the official data. The same thing is happening with silver. China is the largest industrial consumer of silver on the planet. They use it in solar panels, in electronics, in batteries, in 5G infrastructure. But they are also accumulating silver as a monetary asset because they know that when the BRICS nations launch their gold-backed trade settlement currency, silver is going to be part of the basket. The yuan is going to be partially backed by commodities. And the countries that control the physical supply of those commodities are going to have the leverage in the new monetary system. Meanwhile, the United States is sitting on a $36 trillion national debt. The Treasury is rolling over trillions of dollars of short-term debt at 5% interest rates, which means the interest expense on the debt is now over $1.2 trillion a year. That is more than the defense budget. The only way the government can keep funding itself is by issuing more debt, which the Federal Reserve has to monetize by printing more dollars. We are in a sovereign debt spiral. The dollar is being debased in real time, and the only reason it has not collapsed yet is because the rest of the world is still using it as the reserve currency for global trade, but that is changing. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the new members that joined in 2024, Saudi Arabia, UAE, Egypt, they are building an alternative payment system that bypasses SWIFT. They are settling trade in yuan, in rubles, in rupees, in gold. They are reducing their dollar reserves. And when the tipping point comes, when the global demand for dollars drops below the supply that the Fed is printing, you are going to see a currency crisis that makes the 1971 Nixon shock look like a minor policy adjustment. In 1971, Nixon closed the gold window and ended the convertibility of the dollar into gold. The world went from a gold-backed monetary system to a pure fiat system overnight. And what happened? Inflation exploded. Gold went from $35 an ounce to $850 an ounce by 1980. A 24x return in 9 years. Silver went from $1.50 an ounce to $50 an ounce, a 33x return. And that was with the dollar still being the dominant reserve currency. Imagine what happens in 2026 when the dollar loses its reserve status and the world realizes that the $36 trillion debt can never be repaid in real terms. The only way out is inflation. The only way out is currency debasement. And the only assets that are going to protect you are the ones that cannot be printed. Gold, silver, real estate, productive land, energy infrastructure. These are tier 1 assets in the real world, not just on a bank's balance sheet. The regional banks understand this. That is why they are hoarding metal. The central banks understand this. That is why the BIS wrote the Basel III rules to incentivize physical accumulation. The sovereign wealth funds understand this. That is why China and Russia and India are buying thousands of tons of gold every year. The only people who do not understand this are the retail investors who are watching CNBC and trusting their 401k statements and believing that the digital numbers in their brokerage account are going to protect them when the currency resets. I am not trying to scare you. I am trying to wake you up. The data is all public. The BIS reports are online. The COMEX inventory data is published every day. The Federal Reserve balance sheet is updated every week. The Treasury International Capital reports show you exactly how much foreign capital is flowing out of U.S. bonds. All of this information is available. You just have to be willing to read it and connect the dots. And when you do, the picture is very clear. We are in the endgame of the fiat currency experiment. The institutions know it. The central banks know it, the sovereign governments know it, and they are all positioning themselves to survive what is coming. The question is, are you? I am actively securing my own Tier 1 physical assets outside the banking system. I am not waiting for the headlines to tell me it is time to move. I am not waiting for the FDIC to seize another regional bank and trigger a panic. I am doing exactly what the banks are doing, not what they are telling me to do. I am converting fiat currency into hard assets while I still can. I am buying physical silver and gold from reputable dealers. I am taking delivery. I am storing it outside the financial system. I am building my own private reserve, because I understand that when the reset happens, the people who own real assets are going to be the new wealthy class, and the people who own paper promises are going to be wiped out. If you want to see exactly how I am structuring my own physical metal position, if you want access to the spreadsheets and the allocation models and the dealer comparisons and the storage strategies that I am using to build my own Tier 1 reserve, then click the join button below this video and become an insider member of the channel. The membership gives you access to exclusive content that I cannot post publicly. It gives you the tools and the research that I am using to navigate this crisis. And it supports the channel so I can keep producing this kind of in-depth financial intelligence without having to rely on corporate sponsorships or algorithmic appeasement. The banks are moving. The central banks are moving. The sovereign governments are moving. The only question is whether you are going to move with them, or whether you are going to be the last person holding fiat currency when the music stops. Make your decision. Do your research. And I will see you in the next video.